Hello and welcome to the State of the Economy discussion. We are about to get some of the most important numbers, the GDP numbers for the first quarter, that is April, May, June quarter. Well, it has come in and it has come in at 7.8%, almost bang on. The CNBC-TV18 poll was 7.9%. RBI was forecasting 8%, but 7.8 can be counted as a tad disappointing. At 7.8, I'm still looking for the gross numbers. I think we would be just about making it to 40 lakh crore or not even that, which means we would be in terms of quarter on quarter, that is compared to quarter four, where we did over 43 lakh crore. This is going to be a little less than 40 lakh crore real gross domestic product. And that would be a bit of a disappointment. It would be a good 8% lower than in terms of output than what we produced in the first quarter, in the fourth quarter, that is the Jan, Feb, March quarter. That would be a bit of a disappointment. There were plenty of people who were expecting that it would be not just 8, but maybe 8.3, 8.4. So this is going to come as a bit of a bolt from the blue for the optimists. Okay, let me give you the individual numbers. I think farm sector has let down a bit. Our poll threw up 4.1. It's come in at 3.5%. You know, the impact of the monsoons is going to be felt in the Kharif. The Rabi was all right, and that's what is counted in April, May, June. So 3.5 could be a disappointment there. Mining sector at 5.8 also works out to be a little lower than what our poll threw up. Oh, manufacturing is definitely a disappointment at 4.7%. I think we got a fairly strong number in our poll of over 7% for manufacturing. So that's not worked. Construction at 7.9 is decent. But again, not enough to make up for what we have not got very good. Okay, let's look at more numbers. Give me a minute. Manufacturing 4.7. Electricity, the utilities are also a disappointment, 2.9%. Construction has come at 7.9, as I told you. Trade, hotels, transport and communication, the big sector which accounts for all the services, ST buses and Udupi hotels, that's only 9.2%. That's a bit weak. I mean, seriously weak actually, 9.2%. I say 9% is weak because this one took a huge hit in 2021 because of the lockdown, and it's quite clearly not got its mojo back. So this one will count as seriously weak compared to what it was in the fourth quarter. And then you have finance, which has done very well, 12.2%. That is finance, real estate and professional services. And then public administration has not done too badly, actually. So public administration, defense and other personal services. That is important, and that's done reasonably well at 7.9%. I will have to come back on the other numbers in terms of private final consumption expenditure. I'll do that in just a minute as we calculate. But let me get first thoughts. Dr. Pranab Sen, 7.8% growth, sir. Your thoughts on the initial numbers?
Well, not too bad.
Okay.
But slightly disappointing, as you said. I mean, I would have hoped for something around 8 or a little above 8.
Okay.
But then, you know, frankly, given the measurement issues, one can't really quibble with this kind of difference.
Okay. Yeah, it's quite possible that we are, squabbling or quibbling too early, and the revised numbers give you a different picture. Sakshi, I also have with me Sakshi Gupta, the senior economist at HDFC Bank, DK Joshi, chief economist at CRISIL, and Nikhil Gupta, the chief economist at Motilal Oswal. Sorry, I didn't introduce you all. But Sakshi, your thoughts? 7.8 subpar or in line?
So Lata, this is completely in line with what we were estimating. Okay. So I had a number of 7.8% growth. I think if you look at the details of the GDP data, it kind of gives you the impression that services continues to hold up, although I think this 9.2% for trade, hotels and restaurants is very, very low because, as you said, last year, first quarter, there's also a base effect. So this number ideally should have been higher, which kind of signals that perhaps some part of this catch up in services activity that we've been seeing for a number of quarters is perhaps now beginning to slow down. I think the other disappointment, I would say, is the construction activity, because I think given that both the center and state governments have been front loading a lot of the capex, and from the steel and cement high frequency indicators, they seem to be suggesting that construction activity still holds up. So I think that was slightly lower than what we were estimating for this quarter. But I think overall this GDP data is a combination of course, some bit of base effects, and also an indication of the fact that there are now some early signs that perhaps activity is beginning to slow down in certain sectors, and I think that will become more pronounced as we progress through the year.
Okay. If you thought that the government number has come in as a disappointment, may I disappoint you a little more? If you looked at the data from the expenditure side, government expenditure has fallen, Sakshi. It's fallen by 0.8%. But perhaps we should cheer up a bit, because private final consumption expenditure is up by 5.9%, up to 2.3 lakh crore or 5.9%. Remember, in Q4, it was only 2.8%, and we were all disappointed. So this perhaps is a bit of a cheer that private final consumption expenditure has recovered a bit, and capital formation has more or less kept the mojo. It's up 7.9%, coming in at about 1.4 lakh crore. No, I'm sorry, I'm getting it wrong. 14 lakh crore. I'm very sorry. 14 lakh crore, and private final consumption expenditure at 23 lakh crore. They are slightly better, at least private final consumption expenditure, than the record that we had in the previous quarter. First thoughts, Mr. Joshi?
Well, I think the overall number is a little lower than what we expected, because I think the indicators, particularly the government investment, was pretty strong in the first quarter, I think both by the central and state governments. So I would have expected investment to be somewhat stronger. And I think the manufacturing, it's early days, but manufacturing sector not doing too well is something that we should expect going ahead also, because there will be headwinds from the export side. Sectors that service manufacturing will be in a slow lane. On the construction front, I think the number is 7.9. Yes. I'm not too disappointed, because it is over a very high base. So I think from that angle, I think construction activity is fine. So basically, good news here is that earlier there was apprehension that private consumption expenditure is slowing down, because that is what the second half of last fiscal year data was showing. Yeah. But now I think this is somewhat encouraging. But this consumption is largely, I believe, urban centric, because the services sector, which is growing fast, I think is largely in the urban area.
Mr. Joshi, I must interrupt you there, because I'm just doing the calculation. Trade, hotels, transport and communication in our poll gave us a very handsome number of 12 point... Wait, 1 minute. Trade hotels was 12.3% in our poll. At 7.8, the total amount, in aggregate numbers is 6.49 lakh crore. That's a whole 20% less than what it was in the Jan-Feb-March quarter. Now, I know for the last few years, post-COVID in particular, after that big lockdown quarter, we have seen Q1 doing much worse than Q4. Now, let me put it in perspective for those of you who don't look at GDP numbers very closely. Q4 is a very strong quarter for India. Jan, Feb, March, it's a full throttle production. People are reaching out to targets on March 31st, 2 months of 31 days. So it's really a good quarter for India. And it's called also the busy season. The slack season starts with April. Rains start in large parts of South India in June. Sugar production is over by March. There's no crushing after that. There's very little construction in June, starting from June. So quarter one does tend to be less than quarter four of the previous year. But it is usually about 3%, 4% less. This time it is 20% less on trade, hotels, transport and communication, the big services sector. Nikhil, with that, preface your thoughts.
Thank you, Lata. So Lata, the headline number is definitely better than what we were expecting. We were at close to 7.2, 7.3. But as far as the details that you have told me, I think there are a couple of things I want to highlight. First of all, you mentioned that public administration and defense services, which includes government spending and a part of the unorganized sector.
Yeah.
You told us it has shown very good growth
7.9
in Q1. And the expenditure side suggests that government consumption has actually declined, which implies that probably the unorganized or the informal sector is actually doing much better, at least going by this quarter data, which is a very good thing. On the manufacturing, I'm really disappointed because we were also expecting 7.5%. And considering the fact that we know in this quarter there was a lot of compression on the input cost side, prices have gone down and they were able to maintain margins or probably slightly better this quarter. And lastly, I want to highlight that while real GDP growth is broadly in line with consensus, better than our forecast, but the nominal GDP growth is only 8% in the first quarter, which means the deflator was broadly flat because WPI plays a very important role. So overall, as I mentioned, better than our expectations. And the internal, I think the fact or my understanding that the informal or the unorganized sector is growing at a faster pace or has done better than expected, I will take that as a positive.
Okay. Well, I think that's a point I should have mentioned. Nominal GDP this time is not very different from real GDP because the wholesale price index, which you used to deflate, I mean, again, for those of you who don't care for GDP numbers so much, when you count how much India has produced this year versus last year, you count how many cars, how many, airplanes or whatever, but you obviously take the price effect and then you have to deflate it to previous levels. That deflator wholesale price was negative. So that's why your nominal GDP is not very different from the real GDP. But leaving that aside, I think, Nikhil, the big point I get from you is the difference you have noted. In public administration, the growth is 7.9, but government from the expenditure side has not contributed at all. So it looks like the informal sector has grown. That's an extremely cheerful thing. Dr. Sen, it's positive if these other personal services have done well. But how does that tie in with the fact that trade hotels has not done so well? Even that is a services sector, isn't it?
Yeah, I mean, look, it is a services sector for sure. But as far as the trade hotels and restaurants are concerned, a lot of the growth that we are picking up in these figures are those of the organized part of the trade hotels and restaurants. And a very large chunk of this sector is actually in the unorganized sector. Now, I think there's a little bit of tapering off on the consumption of these services by the higher income groups, which is what is getting reflected.
Okay.
But I think more importantly, Lata, I think what we have to note is the fact that the private final consumption expenditure, which has grown at 5.9%, is significantly below the growth of GDP, which essentially means that there is still a lot of rebuilding of household savings that is going on. And that is, and I suspect that this is going to continue. Although the good news this time is that capital expenditures, gross capital formation, seems to have done significantly better and back to something which is reasonable. It's around 34 to 35% of GDP, which is not bad. That can give us a growth rate of somewhere around 7% if it sustains.
Yes, it is 35%. Actually, same as last year, same time, the capital formation. But actually, the pace of growth of capital formation is less than the previous quarter, if I remember right. I'm not able to place my... I'm not able to remember the number, but capital formation has been strong for a few quarters. Okay, now, Sakshi, I just want a word on the other numbers that came today. Core sector was strong at 8%. That's for the month of July. But if you looked at the tax growth, gross tax revenues, so there's no cheating here, no saying I gave to the states upfront or anything. I'm only looking at gross tax revenue. And that's grown just 2.8%. The budget estimate was for a growth of 10.5% or 10.4 if I'm not mistaken. So all told, I mean, government as a propeller may not work much this time. How do you square all these numbers that we've got? The GDP numbers slightly subpar, I would say, especially when you compare to the fourth quarter. The core sector good, but taxes a little disturbing. Your thoughts?
Right. Yeah, Lata, I think on the fiscal side and, the tax growth numbers that you're talking about, I think for the first 4 months or so, we've seen that, gross tax revenue collections have not been in line with, the kind of track or trend that we would have expected. And I think one of the reasons for that is that corporate tax collections have been, much lower. I think going forward and in terms
may I
of,
interrupt?
tying this
May
up
I interrupt,
with the...
Sakshi? I take your point on corporate tax, but just this month, income tax is less than the same month last year. I mean, I was shocked. That's not happened in a long time, but income tax is less. Go ahead. Sorry.
Yeah, I mean, so if that's the case where you are, also seeing the income tax collection going down, I think this kind of ties up with this broader story that perhaps there is now, a slowdown in income or consumption growth in the economy. I think we've just seen, a lot of support coming in from consumption, at least in the first half of last year, some moderation that spilled over into the second half of last year. But I think that now is kind of perhaps gaining further traction. Moreover, I think you mentioned the fact that how does the capex by the government kind of feature into this? I think so far, or at least the impression that we have from the data that is coming out, the government continues to push ahead with their capex spending. So you haven't actually seen a lot of revenue spending so far this year. But if you just compare the capex number, as I said, both for the center and surprisingly even for the states,
yes,
they've been very, very high. And if you compare it to last year, there's been very good traction. So I think the support from the government side, I would still expect, the capex story to continue as we go forward. And I think that's going to remain a focus.
Okay.
Although I think the slowdown in tax collection growth, of course, makes the fiscal math going forward a little troublesome, but we'll have to
Comes as a surprise,
see how the traction there.
On a month-on-month, July was 65,400 crore income tax compared to 69,100 and odd crore a year ago, July. Though year to date, April, May, June, July, the income tax collection is about 6% higher. But even then, it's a far cry from the overall 10.5%. And actually, income tax was doing the heavy lifting, where corporate tax was not chipping in. But now the only thing that has worked in the entire revenue list is the non-tax revenue, and that's obviously RBI dividend. Otherwise, the fiscal numbers look a little worrisome. Okay, coming back to GDP, Mr. Joshi, if the first quarter is 7.8 against RBI's 8%, the subsequent quarters, RBI's numbers themselves are receding all the way to, I think, 5.3 or thereabouts by the time we come to the last quarter. And now there is an added point that has to be put into the model of agricultural output that may not be as good as one thought perhaps when the forecasts were made. So do you think that we are going to see RBI and all of you lower your GDP forecasts for the year?
Well, we were already at 6%, so we are likely to retain our number. You are right. I think that this probably is the peak growth performance in any quarter this year. And in the second quarter, I think you will also see inflation eat into some of the discretionary spending because food inflation has been quite high. And after that, I think there are other headwinds, I think, which will come into play. The lagged impact of interest rate hikes that RBI did, the global slowdown, which is supposed to become more intense in the second half compared to the first one, that will have impact on your exports. And then I think what you mentioned right now, the monsoons, I think the August has been probably one of the driest months in decades. And if September also repeats like this, I think then it will dent agriculture GDP, which has done exceptionally well in the last couple of years. So there are headwinds to growth going ahead. So that's why we believe growth slowing to 6% from 7.2% last year.
Oh, okay. So let's see what the Reserve Bank does with its numbers. But I must point out to the bright part as well, 7.8% per se is a number we should be happy with. It's just that the fall from the Q4 output of 43 lakh crore to come down all the way to just about 40 lakh crore is clearly, a huge 8% fall in output is not par for the course. That was not how we used to grow in the pre-COVID years. Q1 used to be at best 2 to 4% lower than Q4. So that would be a point of bother. And also a point of bother is perhaps the tax collection, which one would have thought should grow better for governmental expenditure to continue. But there is a very bright number in the core sector, especially coal, 14.5%, steel, I think 20%, and even cement and electricity doing reasonably well at 7-8%. So, there are some bright sparks as well in the data. Nikhil, you have your excellent work on household savings not keeping up to speed. How do you tie it in with all this? Do you think we can continue with this kind of capital, gross fixed capital formation? What are your thoughts on consumption?
So, Lata, on annual basis, I find it very difficult that our investment rate this year will be higher than what it was last year. If that has to happen, then my savings rate has to be much higher because it is almost unanimously believed, and I don't think there is any differences in opinion regarding the current account deficit, which is expected to be lower than what it was last year.
Yes.
A large part of that is because of lower commodity prices, and inflation plays a very important role there. But all said and done, if current account deficit is expected to narrow, the only way investments rate can increase is if my savings increase by a faster pace. And if savings rate increases, then my consumption has to come off, provided my income growth is similar to what it was last year or somewhere about that. I have no reason to believe that my income growth this year will be higher than last year, which means that if my savings rate go up, if my savings are higher this year, then consumption will take a big hit. And that is something that we have been highlighting to all our clients. It is either consumption or household investment. We have seen, one of the biggest surprises for me, apart from that public administration, was finance and real estate sector, which showed really, really good growth, at least as far as my expectations were concerned. And I believe real estate has played a very important role there, and households within that has played a very important role.
So your sense is
financial savings.
Are you guessing financial savings have come up better than what they were? Is there any reason to believe that, or do you think that continues to worry you?
That continues to worry me. Even if Q1 turns out to be better, we need to go a long way because our calculations suggest that net financial savings were at just 6% of GDP last year, which, if true, would be the lowest in almost 3 decades. From 6 to 7, or pre-COVID, it was 7.5 to 8%. So there is a long way to go. And for that, either income growth has to be much better, which is not our base case. And if that is the our base case, then your consumption growth will be much weaker, which is where we fear the slowdown in GDP growth would come.
Okay, I think the latter scenario is what looks like playing out. Let's hope things will be better. But then with the monsoon playing truant, we shouldn't be too optimistic, perhaps, that there will be any other help for incomes to grow. The fact that income tax is lower is telling you something. Dr. Sen, if you could put all this together, Nikhil's seminal work on the 8% growth economy speaks very strongly about how he starts with the argument that savings has fallen to 6%. Well, anyway, going by all the data that we have in front of us, would you say that we should be prepared for a slightly lower than the 6.5% growth that RBI forecasts?
Well, Lata, the thing is, 6.5% in any case, I think, was a little bit of wishful thinking. I don't think most of us put our expectations anywhere above 6%. And mine was, in fact, sub 6%. It was 5.8. And I don't see any reason to change it. I think it is going to be sub 6% over the course of the year. The real issue is whether or not we are in a trajectory which can then ramp up in the future. And that's what the point that Nikhil is trying to make, I think, in terms of savings. Now, the point is that if indeed we have a situation where the non-corporate sector is starting to revive, then the financial savings of households will go down. It's in the nature of the beast. So that in and of itself is really not the issue. What is really the issue is the gross household savings. And gross household savings, to me, appears to be going up. And given the weakness that we are seeing on the financial savings side, where Nikhil is absolutely right, what it means, in effect, that the non-corporate sector is starting to revive its investment, which to my mind is actually very, very good news. Because in the absence of a strong MSME sector, we are going to have a lot of problems with employment. We already have a problem with unemployment, the unemployment figures that are around, and it will get worse as we go forward. So I think we still have a little bit of time to go before we get into a situation where consumption becomes a growth driver. At the moment, we can just hope and pray that the trend that we are seeing in terms of the non-corporate sector investment, that continues to ramp up in the future, even if the overall GDP is somewhat softer.
Okay. Well, so we will end this conversation on that optimistic note that hopefully consumption will do at least as well as it has done in the first quarter, and that the non-corporate sector's investments also continue. Dr. Sen, Shakshi, Mr. Joshi and Nikhil, thank you very much for adding your thoughts and adding to our understanding of the GDP numbers. GDP numbers slightly subpar, and I'm not even taking our poll, I'm just taking Reserve Bank's forecast at 8%. This is coming in at 7.8%. So we have reason to be slightly disappointed. But the positive over there is the financial sector has done very well at 12.2%. And personal final consumption expenditure, private final consumption expenditure, which was a disappointing 2.8 last quarter in the Q4, has come in at almost 6%, 5.9%. That is a positive. And gross fixed capital formation at 7.9 is still a positive. Let's see if we can build on these positives, or El Nino has something worse coming for us. Thank you very much for watching this special edition of State of the Economy. Stay tuned, more news and updates follow.